Hey traders, Nick here looking at IBM. So my history with IBM is, I've said it many times before, I can't believe their CEO still has her job. Ginny Rimetti, however you pronounce it, talks, sounds like she's saying the right stuff, but it's all generic. I remember seeing it one time years ago when she sat down with Tim Cook and they were talking. It was like, if I didn't know these two people, it could have been ABC company, whatever they were talking generalities, technology this, and we were going to do this for the job number one. And it was just bunk. So that was the start of the demise for the company. So today's trade, believe it or not, today's video is to say why I went long this week. Because I set my feelings aside and I saw some pretty bullish price action, technically speaking. So here's the lowdown. So first, let's look at the fundamentals. First of all, the macro is okay to me. You've heard many inputs on that from my perspective. And the micro, which is what we're looking at here, from a PE perspective, is pretty cheap, like 11, 12, 13, something like that. Depends on what you look at, which platform you look at. And these are trailing 12 months. So what she's failing to deliver on is the actual shift into, quote, the new tech world. So everybody wants subscription service. And it's clear that Microsoft made the turn. It's not clear here. They keep telling us, but they keep pushing AI and Watson. I remember, I could be crazy, but I'm pretty sure I was a teenager when I first learned about their AI. I forgot what they called it. Big Blue at the time. Was it called Watson? I can't remember. Beat the chess champion. Was it Kasparov or somebody like that? But I was a teenager, and I'm not a spring chicken. So it's been decades. And yes, AI has a future, but I don't think they have a head start. Like Netflix has a head start in its arena. Uber has a head start. These guys don't have a head start on anything, and they're still trying to shift. They could be doing good things, but it's not tangible. They keep disappointing with their reports. It's like a toilet bowl as far as comps. Nevertheless, today's review is upside opportunity just purely based on technicals. So the fundamentals are discouraging from the upside perspective, but the downside is somewhat limited because it's so cheap from a valuation perspective of PE, price to earnings ratio. So, all right, so this is a daily chart, and this was a hideous drop, and the way the price action unfolded is pretty good because it bounced hard with the market in 2019 and then leapt higher on whatever they said here in earnings back in January and left a big gap. So they tried to hold that big gap, but once they lost here, this was a sure thing because it's not a perfect head and shoulders. Actually, it might be. So they attacked this neckline. They tried to hold it. They couldn't. It was too much. They closed the gap almost. Little gap open here. It doesn't matter for me. So now what? Now I see something opposite. So technically speaking, I was posting something from Twitter, sharing a tweet from Trump. So shoulder, head, another shoulder. Bottom line is neckline getting attacked, and they closed above it. Usually they go up that much. I'm eyeballing here. I don't use fine lines, so this should be the target somewhere around here. But I look left, and I see that there's going to be a tough zone right here, just above today's close. Today is, what is today? Thursday. And, there's a gap here, so maybe they're headed to close that gap. God, I was just saying the same thing about Caterpillar, almost the same numbers. And this is definitely a tough spot. If I look left, this is exactly this spot. Complete disaster from October. So this is the October disaster for IBM, and this is exactly the one island candle that they had on that day. I'm going to say eyeballing it 15th, 14th. So it won't be easy. So this would be my target. Anywhere near this, I'm out if I'm long. I went long this week already yesterday. And I could go long by buying calls, or I could go long by selling puts and put spreads. So there is an opportunity, and where I place the risk is up to individual taste. Some people like to sell puts right here, saying, okay, it's going up and not down anymore. So they collect a lot of money, but it's coin flippish, kind of like buying the shares. So if you buy the shares, it could go up and go down, and I start losing money right away. If I sell a put spread, if it goes up, yay. If it goes down, I'm potentially losing money right away. So I prefer selling lower and taking in less money for a higher odds of success. Because I take in less money, I'm risking more money if the happens, but I have more odds that I'll survive than here. Okay, so this is a matter of taste. If I buy calls, I want time on the clock, so I'll go out to August, September, depends what they have available. This would be my choice. As far as where I place the risk, it's up to individual preference. If I buy the calls right here, right now, I pay the most, but then I only have to guess direction. If it goes up, I make money. I don't have to guess magnitude, how big of a rally it's going to take. So let's say I pick 148 and I guess up. So same as buying these. But if it doesn't go up fast enough in time, then I wasted my money. I guessed right and I lost my money because I didn't guess the magnitude correctly. So two schools of thought. I like to go somewhere in the middle. So I look at the options and I see what they're pricing in, and I go to the edge of it. And so that's the most, and I'm putting quotes here, realistic leg that they're going to reach, and I buy that or a spread. So it's all based on personal preference. Or if I do both, then I'm really long IBM, and I'm not so sure. So I can sell the put spreads and buy the call spreads or calls or the shares and be really long IBM for almost free. But, if it goes against me now, I'm in a little bigger trouble than I want to. Now, I could go long IBM by selling puts naked, and let me see what kind of premiums they have for that. First, I want to know when they report. So this yearly. All right, so they reported somewhere middle of July. I'm going to guess the July contract will not include the earnings, but I'll double check. So here is the IBM options chain. We're looking at IBM. Today was a good day, after market a little down. So these are the options that are available. It's up to personal preference. If I want a short-term cheap, I go here. If I want long-term more expensive but more time on the clock, I go 57 days, 92 days, all depends. Okay, so this tells me the implied volatility, probably the earnings are in July, because it spikes. See how the market gets nervous? So if I buy anything up to here, they'll be cheap. And then if I go to here, it'll be really expensive because there is an event. Let's put that to the test. So I'm looking at this one, has 22 days, does not include earnings. If I buy a 136 put, it's $1.14. Okay, 135 put is 255. What is it here? 92. So there's a big discrepancy. 7 days should not be that big a difference, but that explains the earnings. So the reason why it gets expensive, because just like the high VIX, when the VIX is high, the fear gauge is high, then everything gets more expensive. The premiums are more expensive. It's called implied volatility. So the implied volatility is 40. What was it there? Half, 20. So if I go 1 week older, same 20. So it's 20, 20, 20, boom, 40. What if I go out to August? Still high, but not as high as before. But with time, volatility climbs because there's more uncertainty, more time for stuff to happen. But for it to go from 20 to 40 in 7 days, it marks an event. Okay, back to the point at hand. If I wanted to sell naked puts, none of these are attractive to me. I don't trust it. And here's the chart. So I don't want to be long the stock. I don't want to be put the stock at 130. That's just, for me, IBM was right there. I mean, $108 not too long ago. I don't want that. So if I was going to sell naked puts, I'd probably prefer go out to November and find something around here to sell a spread or a put naked. But even then, it's not the stock I like to do that with. So that answers that. So as far as upside, if I'm looking at, I'm going to go 140. Okay, 140. I don't know why this is not centering. Okay, there's not enough. So if I go to August, they're pricing in about a about $12 move, air math, plus or minus. So I want to stay within that range from current price of 138. So let's call it 140. So I want to be 155 at most, 152, 153, or 130-ish. That's the span where I expect. If I want to bet against it, I'll go down to the 130-ish. If I want to bet with it, I'll go up in the high 40s. So maybe early 50s. All depends on personal preference and how much time. Okay, but this is for the August. All right, so hopefully this is enough information. So the idea is that in spite of me not liking the fundamentals, it has a few hiccups here, but it could be inside of a breakout already that could take it to here. So I'm saying wide here because I'm saying it's going to do a couple of zigzags, and then once it gets here, if it gets here and it breaks out of here, this second leg, this last bit here is more of an indication that, okay, it's off to the races. I don't believe in it fundamentally. This is a pure bet on the technicals. So here's another weekly view on it. So we'll probably support the same method I just said, that there's another leg higher if, big if. This is a trend line that is somewhere along here. So if this channel, whatever this is, pattern that's going on, is actually broken, onus on the bulls to break above it, they might invite buyers. First here, then here, then here. These are 3 trigger points. So one buying begets buying. So there might be a bigger run higher, but baby steps. Let's get through the first few days. The first day after taking the trade is working well. I got lucky with all-time highs on the market, I guess, but the trigger was there. And this is my point on IBM.